Okay, this is the Blackheath Manufacturing Company case video, and I wanted to go over the case with you, especially some of the key things that are in the book, and also reference some of the aspects that you'll find in the Excel file to help you get a good start. So the basic challenge in this case is to figure out whether or not the decision rules that Lehigh has established for the company's pricing policies are correct. And they're using these pricing policies to make decisions about special orders that come in from time to time. So if you look at the very beginning of the case, it tells you in the first paragraph that output has varied considerably over the various weeks. And you're given an example of week 1, week 2, week 3. And they say that those 3 weeks are pretty indicative of what goes on a regular basis. So that variation in the output is fairly considerable. If you look at the change from week 1 to week 2, that's a 25% change in volume. And then from week 2 to week 3, that's a 20% change in volume. That's a pretty large swing for a company to be able to manage. And so we would make the conclusion based on that data that this company is probably not operating at capacity all the time. Right? We don't know for sure, given the example and the information that we have, what full capacity is. So perhaps that's something we would like to know. Like, where's the top for this company? What's their maximum production given that they're maybe running a single shift? So we can think about it in that way. And then it helps us make better decisions about what the company should use for pricing. Because obviously if we've got back orders and we have a lot of demand for our products, our strategy for pricing is going to be a lot different than if we have excess capacity and we have room to fill more orders. So it's a more vulnerable position to be in. Because obviously a company would want to sell as many units as possible to reach their full capacity, reach their full potential is essentially what that means. So you've invested in infrastructure, in equipment and machinery, and you want to get the most out of that investment. You want to sell as many products as possible, given your existing capacity. All right, so you do have what we consider costs that are incurred, and that's an important aspect when you're setting prices. So there's 2 things that really count when you're setting prices. One is what's the market demand, and what are customers, like if they could switch to competition and buy a similar product, what would they have to pay? So what's the market price for the products that we're offering? That's very important for us to consider. We don't want to be overpriced or we won't sell enough products. And then also we have to be cognizant of and aware of what our internal costs are, because we can't operate long-term without being profitable. So we need our price to exceed our full cost. All right, so now you've got to get your mind wrapped around what's full cost. Well, full cost would include every single cost that the company has incurred. If you look at the bottom of page 5, you got 3 weeks there, the same 3 weeks that are referred to above, and you're seeing the income statement. So you see sales, cost of sales, gross margin, minus other expenses equals net income. And the first week at 400, we're not profitable. So obviously the price isn't high enough in week 4 in order for us to make a profit. But we don't know whether or not we can raise our price. In fact, the case says that there is some price resistance above $7 a unit. And Lehigh talks about that. So in order for them to be competitive in the marketplace, 7 is about as high as they can go. So they're not really getting as large a margin as they want at that volume. All right, then you notice in week 2 at the income statement at the bottom of page 5, they are making money. So obviously break even, let's talk about what that is. Break even is somewhere between 400 and 500 units. So break even is where profit is 0, where net income is 0. It's where revenue equals total expense or total cost. Okay, so that's why we talk about pricing relative to that total cost amount to make sure that we're at least breaking even or hopefully making a profit on the units that we sell. So one of the things we do to help ourselves manage these decisions is we take those total costs that you see there on the income statement and we divide them into 2 groups. The first group being fixed costs and the second group being variable costs. So we need to have a handle on both. Because fixed costs would represent sort of the hurdle you need to get over. You need to cover those costs. You need to generate enough profit to cover those costs before you're going to start making any money. Because you have to cover those costs every year. So in the short term, you want to sell as many units as possible, as quick as possible, to get over that hurdle so that you can start generating a profit. So you have those fixed costs, committed costs that are you really can't change them in the short term. So in a sense, they're not relevant to making decisions about special orders because they're already committed. You can't change them in the short term. Variable costs, on the other hand, vary with the orders. So if you don't have the order, you don't incur the cost, right? So there's zero cost if you don't fill that order. You don't have to buy the materials, you don't have to commit the labor, and so on, right? You fill the orders you have. But the fixed costs are where your risk resides. Those are the costs you have to exceed. So we're most interested on whether or not we can make money, whether or not we can cover the variable costs. Because if we can cover the variable costs, then that profit on every unit will go to cover the fixed costs. And that's important when you're not at full capacity, right? So you want to sell as many units as you can that generate a profit to help you cover your fixed costs, even if you have to make some price concessions to do that. And that's really what's at the heart of this case. It's what you're trying to grapple with and understand. All right, I want to bring your attention on page 5. In the middle, there are several accounts that are listed. These are all production-related accounts. You notice week 1, 2, 3, there's units of output, 400, 500, 600, and then you see the list of accounts starting with direct materials going all the way over to other overhead. I want to bring your attention to 2 of them, the indirect materials and the factory insurance. Notice that the dollar amounts do not change relative to the units of output. And so those are obviously fixed costs. So the amount that you incur related to those cost groups is unchanged. So it doesn't matter if you sell any units at all. If units are 0, you're going to incur those costs. You're going to have to pay for the indirect materials and the factory insurance. That's the idea there. Now let's back up and look at direct materials and direct labor. So those costs increase as volume increases. So you get 2 choices here. It might be a variable cost or it could be a mixed cost, because mixed costs will show a similar pattern, meaning that costs will go up as the volume goes up. But you got to figure out what's the difference then. Let me give you an example. In this group, the indirect labor goes up, right? And the direct labor goes up, the direct materials goes up, the electricity goes up, and the other overhead goes up. So you got to decide which of those that are going up are fully variable, 100% variable, and which ones are mixed. Now let me show you how you do it. Let's study the direct materials. Week 1 to week 2. The increase in the output is 100 units. So to find the percentage change, you take 100 and divide by 400, where you started from. That's a 25% increase. Now let's do the same thing with the cost for direct materials. In week 1, it was 300. In week 2, it's 375. That's a $75 change. So you take 75, you divide by 300, and you get 25% increase. So the rate of change was the same between the volume and the cost. Let's do it again from week 2 to week 3. Units of output go up by 100. So that's now 100 divided by 500. That's a 20% increase. Look at the cost of materials. That goes from 375 to 450. That's a $75 increase. Divide that by 375, you get a 20% increase. So there it is again. So when you have the same pattern for the same periods of time, showing the same rates of change, that's 100% variable costs. And if you did the same thing, you'd find it exact same pattern with labor. So labor is also 100% variable cost. If you look at indirect labor and the electricity and the other overhead, you would find the rate of change for all 3 of those is less or different, I should say different, than the rate of change on the outputs. And so when the rates are different, that implies it's a mixed cost, and you've got to sort it out. And we do that by running the scatter graphs. And you'll see that in the Excel template that I designed for you. I've got them all done. You don't have to do them. You just have to interpret them. And I explain how to do that within the template. So you'll see that. Okay, so again, what's at the crux of this case? It's a company with a single product line. That makes life easy for us, because there's all kinds of other complications we're going to get into in future cases that involve multiple product lines. So let's get this part nailed down first. And his recommendations were based on average unit costs, which includes both elements of variable and fixed costs, which would be fine to do if we had a backlog of orders, if we had back orders and we had a lot of demand for our products, right? But we don't. There's considerable variation there. So you got to be super careful about incorporating the fixed costs in that. So they go ahead with those recommendations of his, and they set prices and policies based on that. And then some special orders come in, 3 of which were rejected. So some of them were accepted, but 3 of the orders were rejected. And in one case, one person was fired for taking on an order that they were told not to do. And you got to decide whether or not they made the right decision and back it up as to what you believe should have been the right decision and back it up with numbers. So in other words, I want to know what's the opportunity cost that they incurred by rejecting those orders. So what profit did they lose by saying no to those orders? So how much would their bottom line have increased had they accepted them? And that's what you're going to grapple with. So I like to summarize the key learnings of each case. So in this case, you got to get your mind wrapped around what's a special order or an irregular order where you maybe would make a price concession, and how do you interpret those when you have excess capacity, which is what we have in this case. Then the scatter diagrams, so the second bullet here, scatter diagrams, being able to create them and then interpret them so that you can sort out what's fixed and what's variable, because that's central to understanding the equations. And then calculating variable cost per unit and total fixed cost to determine break-even point. So when I show you the formula here in a minute, you're going to see those are the elements that you need. And that's built from what you did in this part of the case using the scatter diagrams. And then finally, using what we call contribution margin to help you make those effective pricing decisions. And finally, looking at incentive compensation systems that are referred to at the very end, where the owner is looking to give them an increase in the compensation, their commission, 15% versus 10% commission on the sales, taking a volume hit there. And you got to decide whether or not you think that's a good decision for them to make. All right, so let's talk more about the scatter diagrams. So what we do with these is we take the volume. So in our case, we have week 1, week 2, week 3, 400, 500, 600, and that's your x-axis. So activity is on the x-axis. And then on the y-axis is the cost. So you had several examples. I have a scatter plot for each one. Materials, the labor, the indirects, the electricity, and so on. So then that's the y-axis, and you do a separate scatter graph for each one of these accounts. And then you plot those as coordinates, as points on the graph. So for instance, for direct materials, there's going to be a dot that represents 300 on the y-axis, so you connect it up 300 on the y-axis with 400 on the x, and you place a dot on the graph. So that's an observation. So you'd have 3 observations because you got 3 sets of volume. And then you connect those observations with a straight line. So you add a trend line. You can do that in Excel very easily by right-clicking on one of the dots and adding a trend line as well as an equation for the line. And they are linear lines or straight lines. So you should recognize this formula here at the very top as a formula for a straight line, where y in this case is going to equal the total cost for whatever account you're studying. M is going to be the slope on that line. And I'll come back to M in a second. X will be the volume, the weekly volume that they're producing. And B will be the y-intercept. All right, so let's talk about M and B a little bit more deeply. So B is the y-intercept, meaning that that's the total amount of the cost when volume is 0. And so that to me, hopefully to you too, sounds like a fixed cost. In other words, you incur that level of cost when volume is at 0. So no matter what the volume is, you're going to incur that level of cost. And that's the way this is going to work for you. So B represents, the B in the equation represents the fixed component of the cost. M, on the other hand, is the slope, or the change in Y relative to the change in X. And so that's going to be what the costs, how much the costs vary relative to volume, because you multiply them together. So that'll give you the variable cost per unit. So the slope will be the variable cost per unit. So that's cool, right? The M in this equation is the variable cost per unit. The B is the total fixed cost, total dollars. We don't unitize it. There's reasons for that, and they're especially pertinent to this case. X is just the input amount of the volume, and Y, of course, is the total cost that you achieve in each of these account buckets. All right, so when you get done analyzing each one of those sets of data points, you'll see a graph for each one. You then combine all of those elements, so you add together all the variable costs, so all the M's in the various graphs. You pull them together, and that's what you do on the next page of the Excel sheet. So for item 2, you pull all those ahead, you bring them over one at a time, and you add them all up to get the total variable costs for manufacturing. And then you do the same thing with the fixed from the graphs. You pull those in, and you indicate what the fixed costs are for the various elements. Some of them don't have any fixed costs. Some of them don't have any variable. Remember I said some are 100% variable, some are 100% fixed, some have both. They're mixed, semi-variable. So you're going to sort that out and add them up. So you get total fixed cost. Then you use this formula right here. Now break even is equal to fixed cost, notice in total. So we don't, even when we're calculating break-even point, we don't unitize fixed cost. And in fact, I don't recommend you ever unitize fixed costs other than for assessing long-term performance. But for making short-term decisions, we should just ignore them. They're not relevant. We can't impact them. So why include them? And we divide that by the contribution margin per unit. And your contribution margin per unit is calculated by taking the price of the units, so per unit price, and you subtract the variable cost per unit. That's what you calculated here when you added them all together. Right? You added all the variable costs together. And that would include your selling costs, your commission costs as well. All right, so that tells you what you're doing there is you put fixed costs in the numerator, you put how much do I make on a per unit basis when I subtract my variable costs from my price. So this is how much each unit contributes to covering my fixed costs. How much profit I make on a unit every time I sell one. And that profit goes towards covering the fixed costs. So think of those fixed costs as like a hurdle, you got to get over it. So when you divide that out, it tells you the number of units you got to sell before you reach that point in which you break even and you begin to make some profit, make some money. All right, so the question then is that he uses an average unit cost figure, and you have to decide if that's appropriate. And hopefully by now you've kind of figured out that it is only appropriate if 100% of the costs are variable, which in this case they're not. Okay, so they have the fixed costs, the average unit cost will decline as more units are produced. So for short-term decision making, it's best not to unitize the fixed cost. In fact, what I would suggest is you ignore them altogether and you only focus on whether or not the sale contributes to covering fixed costs. All right, so here's your general rules. Again, I kind of alluded to this and hopefully you picked up on it. You got two ways you got to think. And you got to separate these ways of thinking. Long term, obviously, we need to cover our full costs and make profits so that we can sustain ourselves and continue to invest in the business. But in the short term, we have fixed costs that are committed that we cannot change. And so we need to adjust our thinking a little bit and say, okay, well, what can my short-term prices be for what might be considered a special order or a price that's not my regular price? How low can I go and still make money to help me cover my fixed costs? Is what you need to consider. And that's what I'm trying to get you to wrap your mind around. It's kind of a fundamental thing that we think about in business when we consider making these kinds of complex decisions. And then in the end, you've got to kind of revisit it again one more time and give you a chance to nail it. And give them some advice on their incentive compensation recommendation of going to $8 when you know already that that's going to severely affect the number of units that they can sell. And he acknowledges that. He says, I'll go to $350, but then he's using the unitized cost that's based on 500, and you can't do it. And that's why it's never a good idea, really, to even consider the fixed cost when you're making these kinds of decisions, because you can make these kinds of mistakes in your analysis. All right, so good luck with the case. If you have any questions, please reach out and let me know.